Hey guys, welcome back to Follow Me 11B. Discussions on current events, macroeconomics, and freedom and liberty from a veteran's perspective. It has been a mind-blowing and wallet-busting day on the markets today. Let's cover a few stats and dive into an article. Let's start off with the bond yield. The bond yield jumped on the 10-year Treasury to 3.371%. Oil, big commodity in the news these days. Oil jumped 0.2% to finish at $120.93 a barrel. The Dow down 2.8%, which translates to 875 points lost on the trading session. At one point during the trading session, it was down 1,000 points. It managed to recover back to 875 though. NASDAQ down 4.7%, and last but not least, the S&P down 3.8%, which is down over 20% versus its January high. So now for more on this seemingly crashing market, let's go to an article I came across in Yahoo, originally published in Fortune.com by Will Daniel from Monday, June 13th, 2022. Entitled, Wharton Professor Jeremy Siegel is one of the best stock watchers alive. He says the S&P 500 is already pricing in a recession and bear market. Is a recession already priced into equity markets? The world-renowned economist Jeremy Siegel, not to be confused with Jerry Siegel, co-creator of Superman, says it sure looks like stocks have discounted at least a mild recession amid this year's downturn. On Monday, the S&P 500 officially entered bear market territory, dropping more than 3% to a level of more than 20% off its January peak. And as recession predictions continue to flood in from both Wall Street and Main Street, some sectors of the market have fared even worse. The tech-heavy NASDAQ is now down over 31% since the start of the year, as even the most reliable tech stalwarts have seen dramatic cuts to their share prices. For example, Twitter down 5%, Google down over 4% for the day, Facebook Meta down over 6%, Amazon, of all stocks, down 5.45% for the day. So back to the article. Siegel, a professor of finance at the prestigious Wharton School of the University of Pennsylvania since 1976, told CNBC on Friday that the drop has put some stock valuations into a compelling range for investors. Here's a quote. I actually think the market is already discounting a recession in 2023, he said. It's being priced at that level today. Siegel noted that the S&P 500 is now trading at roughly 17 times forward earnings, and if you exclude tech stocks, the figure is even more impressive at just 13 times earnings. You rarely see it that low, Siegel said. For comparison, over the past 5 years, the S&P 500's forward price-to-earnings ratio averaged roughly 18.6%, but looking back over a 10-year period, stocks are trading roughly in line with the norm of 16.9%. Siegel was asked whether he thought it was fair to say that a recession had been priced in, given that the S&P 500 had seen an average contraction of 31% in each recession since World War II. I think we're pricing in a mild recession, he said. I'm not saying how severe the recession actually will be. My prediction, all probability, it's going to be more than a mild recession. We'll just leave it at that for the moment. Continuing on, though, Siegel went on to explain that despite the recent increase in interest rates in many countries, the global economy remains in a much lower interest rate environment than was seen in the past. Typically, lower interest rates favor higher valuations, so even though the market's current price-to-earnings ratio is near historic norms, it's evidence that investors are predicting a recession. Siegel also questioned if the Fed's rate hikes are enough to persuade investors to forego stocks in favor of fixed income investments in bonds or treasuries. Even if the Fed's, here's a quote, even if the Fed's interest rate is 3% or 3.5%, is that real competition for the real asset that is stocks, he said. Exactly. 100% agree. Who the heck is going to do a long-term investment in a treasury or a bond for years on end when you could make 3%, when you could make 3.5 more in a day on the stock market, even in a tough market? I mean, you could make 1% or 2 in a carefully chosen stock without too many problems. Ugh. The professor argued that some dividend-producing stocks may begin to look attractive to investors as valuations fall and investment options remain limited. Here's another quote. History shows that dividends move with inflation, so you're still getting a real return, he said. Let's see here. Meanwhile, Goldman Sachs analysts led by David J. Costin also argued that dividend stocks may present value moving forward in a Monday note to clients. Dividend stocks look particularly attractively valued in our view, the analysts wrote. Dividend stocks typically outperform in environments of elevated inflation. In addition, dividends currently benefit from the buffer of strong corporate balance sheets. So, another quick statistic, all 11 S&P 500 sectors negative for the month to date so far. 151 new 52-week lows across the S&P today. So, not a great day for the markets. What does this mean, though? In the macro picture, higher rates are going to mean bigger borrowing costs for businesses. So let's just call it costs. Bigger costs for businesses if you do a rate hike mean less, for example, housing. What does that mean? Less housing means less roofers, less plumbers, less electricians, less carpenters, etc. More layoffs, more jobless claims, more unemployment. So the Fed's trying to strike this balance. They're calling it the soft landing. They're trying to cool off the economy and come in for a soft landing so that they don't completely demolish the economy and send it into a complete tailspin. But the chances of that are pretty slim. Matter of fact, this week, the FOMC and Jerome Powell are going to be meeting on Wednesday, and they have been expected to announce a 50 basis points rate hike. However, I've been starting to hear rumblings about this today that they might even turn it up to a 75 basis point rate hike. However, that said, even a 75 basis point rate hike, in my opinion, is like a drop in the bucket compared to inflation. If you really want to fight inflation, which I'm not really sure they actually want to do, they're going to have to do a lot more than a 75 even basis point rate hike. I mean, we're over 8.5%. We're at 8.6% CPI right now. So we're going to have to get in the 8s, the 9s to actually compete with and bring down inflation in real terms. So what do you got, though? What do you got for choices if you're the Fed? You raise rates to fight inflation. Well, what's going to happen then? You're going to hurt investors. You're going to hurt the stock market. You're going to hurt retirees that are living on fixed incomes by raising those rates. But if you have insufficient rate hikes, that's going to mean continued inflation, less purchasing power, and more of the reverse wealth effect for the population, which is some of what they want, in my opinion. So that's why, in my opinion, this is why they're doing rate hikes, but they're doing small rate hikes. Because I was watching a recent Peter Schiff podcast, and he posed the question, I think this is even posed on Capitol Hill to Jerome Powell recently, but if you know you need a 2 or a 3% rate hike, why don't you just do it? Why are you doing a half a point, 3/4 of a point? Why don't you just do the whole point, the whole rate hike that you want right now? And the answer is they can't. Otherwise, it will tank the economy very quickly. But let's go back to the original question. Has the recession begun yet? Well, I don't think that that's official yet, but I think the numbers might even come out this month, June 2022, to see if we have got our second quarter of negative growth. So, our second part of the question, are we in an official bear market? Well, according to most investors, an official bear market begins when the S&P finishes close of business at down 20% from its peak. And like pessimistic investor sentiment is kind of the thought of the day. I definitely think we got the pessimistic investor sentiment. We are down over 20% from the January high in the S&P. We're down 3.8%, down I think it's 22% since the January peak. So yeah, we are officially in bear market territory. So, but that is my thoughts on, are we officially in a recession or are we officially in bear market territory? I would love to hear you guys' stories about the bear market and thoughts on how close we are to recession. In the meantime, until the next video, we are growing. We are Follow Me 11B on Facebook, on Twitter, on YouTube. We are the real Follow Me 11B on Instagram and on Rumble. And we will see you all on the next video.